And to do that, we've got the mid-cap maverick, Sunil Singhania, to talk about markets, valuations, the fear, the anxiety which a lot of people have after the recent run-up. How should one really address the market? There are two choices which I just mentioned right now. The choice of being on the sidelines and waiting for the correction to come in, or participate with a downside and with really a view that you will have to digest a 10-15% volatility. Sunil, fantastic to have you back. Thank you for joining us. After a 22% uptick for the quarter gone by in the Nifty, our first show for 2021, I was hoping that you'll start with a bright smile on your face.
Good morning and Happy New Year to you, Aisha, and everyone at ET Now, all the viewers. I think, markets are the way they are. There's always optimism for people who believe in the long term. And there is always, I would say, concern for people who keep on looking at all the challenges which come by. And, life is full of challenges. And there is disappointment for people who try and wait for the exact time to invest in the market and who are never able to do it. So being an optimist always, I think we are always smiling.
Okay, so Sunil, the optimist believes that things will only improve. The pessimist believes that valuations are stretched and things will come down. But what about the realistic? Now, the case for the realistic is that markets are not cheap. Stocks have run up. Yes, things are incrementally improving, but is it time now to get very, very selective?
No, I think you're right. Things are definitely not cheap. But equity markets are all about the future. Equity markets are not about the past. And the second thing is, you have to be an optimist to be an investor in equity markets. If you believe that the future is going to be good, then you invest in equity markets. So, coming to the earnings question, you're right that trailing Nifty earnings are at 35 times. However, Nikunj, we should not forget that this trailing earnings include 2 quarters, which is March 20 and June 20, which were really, really, challenging quarters. And I think when you look at that, and also the fact that September we had an earnings growth despite a fall in sales, and December our view is that earnings will surprise massively on the upside because a few sectors which are contributing negatively to the earnings, like corporate banks, metals, even I would say telecom, would turn massively. And therefore, our view is that as we move ahead, this trailing PE would keep on coming down. In fact, on a FY23 basis, our view is that the PE for Nifty might be maybe 16.5, 17 times, which is 10% higher than the long-term average. But given the way we are in terms of lowest ever interest rates and so on and so forth, I think it is very logical to make a case that this PE band has inched up on a permanent basis. Also, the constitution of the Nifty has been changing quite dramatically over the last 4-5 years. So last 4-5 years, the so-called good companies and FMCG companies and, high ROE, low debt companies have attracted investor interest like never before. So a lot of these companies trade at PE multiples of 80, 90, 100, and that also distorts the average PE multiple of the Nifty. So our view is that it is possible that, Nifty might be sort of flattish or might see smaller growth, but the broader market is where, opportunities will lie.
Sunil, we'll get into broader market and what your recent purchases are, just to allude to the broad thought you have. But I'm going to take the clock back, let's say, to October. The universal theme in the month of October was IT pharma digital or digital IT pharma. Now suddenly the inward-looking sectors have made a comeback. Points which you've alluded to: steel, cement, lot of mid-cap machinery and industrials. Investor now has 2 options: lean towards the growth part, digital IT pharma, or go back to the value part, which is steel, cement. How should the split be?
So, we continue to be positive on IT, digital, pharma. I have always said that we are unfortunate that in India, the digital part is predominantly in the private domain. There are very few listed companies, and we all know what has happened to those listed companies. My view is that interest in the digital theme will continue because it's a theme which has just started, and there are strong legs for years to come. IT and pharma will continue to be sectors where India has global competitiveness. Tailwind is great, and companies in that domain in India have the expertise as well as the global competitiveness to survive and grow for a long time. Having said that, we should not forget the fact that we are now coming out of a period where last 3-4 years, Capex has not happened. We are also seeing strong growth emerging. And, obviously no one expected this kind of a growth 6 months back, but it has happened. And with interest rates where they are, I think there is a multiple benefit of that. One is corporate earnings go up, projects become viable because your interest costs are lower. And on the demand side, your EMIs are coming down massively. And therefore, autos, particularly passenger vehicles, four-wheeler as well as two-wheelers, even residential houses, the EMIs on a monthly basis have fallen by 25-30%, making them more affordable. And again, they know that it kickstarts the whole process of higher demand. And because there is no capacity, obviously, companies who have capacity will make more money, and they will go back into the Capex mode for the next phase. Government has also been proactive finally after years, and this PLI scheme, along with incentives for new manufacturing in terms of lower income tax of 15%, and the fact that China is the villain of the world, and that also is leading to a move of sourcing away from China selectively. I think all this means that we are going to have a holistic kind of a growth as far as the economy is concerned, and also as far as the market is concerned. So from being like a 10-15 stock and maybe a couple of sector market, which was the case last 4-5 years, I think the time is now ripe to have a more inclusive kind of a portfolio approach with, the traditional good sectors, the so-called defensive or the stable sectors like IT, pharma, matching that with some of the beta names, and I would include the financials, some NBFCs, corporate banks, even engineering, metals, and so on and so forth in that bracket. So I think it's now a case for a much broader portfolio.
Okay. You also own metal stocks in your portfolio. Metal stocks are going through a massive surge. When we speak to steel companies and the metal companies, the managements, they tell us, इतनी तेजी हमने जिंदगी में नहीं देखी है. Is there still a trade left in metals, especially steel?
So, Nikunj, I would say that there is no one in the world who would have predicted the kind of price rise which we have seen in commodities generally. And it's not only steel, it's across metals, it is also across agri-commodities. You see the price of soya, you see the price of corn, even, international sugar prices, and so on and so forth. They're like, corn, soya, even wheat, they're like 4 years, 5 years highs. So it is a sort of a synchronized move up. And again, it's largely liquidity, dollar weakening, a lot of actual demand being matched by investment demand. As far as steel is concerned, frankly, I don't know whether these prices are going to last. But we should not forget the fact that 1 or 2 years of these kind of uptrend completely changes the balance sheet of the companies. We have seen companies who had like huge debt, and the way the profitability is panning out in the next 3-6 months, they would be either zero debt or their debt equity will come down to like 0.25, 0.5 times equity, which used to be like 2-3 times equity. And that would mean that going forward, the resilience they will have, even in terms of bearing slightly lower prices, would be huge. Again, I'm saying I don't know whether these prices are going to rise, but I would say that if you get an opportunity when the news flow comes that the prices of commodities have come down by 10-15%, and you get stocks maybe 25-30% lower than these levels, it would surely be a buy. At these levels, you have to be selective. You just can't extrapolate the current price and current profitability and say now this company is available at 3p, because that would be discounting the peak profits and peak metal prices. Maybe, I don't know. So, be a little bit cautious, but the balance sheets will be definitely repaired meaningfully. And that again comes down to our view that select corporate banks would be great, I would say, alternate ways of playing, because a lot of these banks suffered due to the fractured balance sheet, particularly in the metal, infra and power space.
That's one way of looking at it, Sunil, that corporate banks will come back. But if I take a leaf from your answer, which is that companies are also looking at retiring debt. And obviously companies which are generating superior cash flow, they are retiring, which means they are good companies. If good companies are looking at retiring debt, and if that is a talking point why one should be buying some of these stocks, then who will go to banks for borrowing?
No. So I am not a proponent of investing in debt-free companies, and I publicly said that. I always say that if you are able to manage debt, it is going to be great. So, the retiring debt is by companies who are struggling. They have got a new lease of life. And the first thing is that, use this opportunity and clean up your house. At the same time, if you see the largest cement company announced like a massive Capex, starting some 6-7 projects together. I think the same is going to happen in a lot of sectors where good companies will start taking up expansions. In the steel sector, for example, last 3-4 years, all the major steel companies were able to buy stressed assets through the NCLT route. So Tata bought Bhushan and JSW bought the other Bhushan and Vedanta bought Electro Steel and so on and so forth. Now they are all running at almost full capacity. So for them to plan their future growth, they will have to come and start planning greenfield projects. And I think that is going to lead to definitely some Capex. The other thing is the PLI scheme is incentivizing you to set up new capacities in sectors where India did not have presence. So, electronics, for example, even chemicals, large projects are coming up. And the projects are not only in the base chemicals, which India was, very, I would say, good at and had large capacities like caustic soda, but even downstream. And I think that would, again, lead to a decent amount of Capex requirement. And the third thing is with falling interest rates, which I mentioned earlier, it is becoming more viable for individuals to buy maybe, consumer goods, vehicles, apartments, houses. And that would again lead to a decent increase in demand for, the retail credit side of the business. So we are basically saying that we are in an environment where credit growth can now inch up to lower double digits. At the same time, the credit cost, which had gone up for some banks to 2-3% of their book, will come down maybe to 0.75, 1% of book. And that would, again, lead to a huge swing on the PBT side.
Okay. Sunil, if I look at your recent acquisitions, again, this is public information. We've looked at information, what is available when the bulk deals are reported. You bought into Rupa, which some would say is a consumer discretionary or a garment company. You bought into Technocraft, which is more like an engineering company. You bought into Acrosel, which is a leading manufacturer of kitchen quartz sinks. There is no correlation in terms of a theme. So what are you trying to, what's the approach here?
The whole portfolio cannot have a correlation. So we are already significantly overweight on IT and digital space. We are significantly overweight on pharma. The only thing is we are very stock specific. I think there are a few themes where things are working out. So India is turning out to be a good exporter for a lot of building materials. And there, anti-dumping duties on China by a lot of countries, competitive advantage as far as the labor cost is concerned in case of India, are helping. And that is what we are playing through one of the kitchen names you mentioned. The other thing is homegrown brands. We are in a phase where you had 2-3 years of headwinds. You had GST, and then before that you had the demon, and then you had COVID, where a lot of these companies faced headwinds in terms of their growth. But now, things are opening up, and particularly branded companies facing the second tier, third tier, and rural side of India are doing very, very well. And that is where, homegrown, I would say, value to sub-premium brands will do very well. So, we do believe in the consumption story of India for a long time. However, we are not in the camp of buying an 80 PE stock if the growth rate is 10-12%. We would buy maybe a 15-20 PE stock where the growth rate also is 15%. And I think that is where this whole focus on decent homegrown brands with very good balance sheets and ROEs, exceeding 20%, that has been the theme. And the third, obviously, if real estate is growing, there is going to be demand for building material. There is going to be demand for ancillaries like cement, steel, and there is also going to be demand for sectors which assist in construction. So the engineering company you mentioned, is obviously a diversified engineering company, but they have a huge presence in scaffolding. And as we have more and more construction activity coming in, I think that part of the business should definitely do very well. And if you see the valuations of these companies, they are mouth-watering. If you take a leap of faith and invest from a 3-4 years perspective.
Okay, let's talk about the digital theme. Now, the one way of looking at the digital theme is you stick with the traditional favorites. Your favorite has been HCL Tech. Right now, market favorite is Infosys and TCS. That's the traditional favorite. Or second, you go down to niche companies like an Apple and Root. You've invested into Root as per the public information. What is a better strategy to encash and to really adapt to the digital theme? Am I right when I said, by the way, HCL Tech has been your all-time favorite? Before you answer the question.
And, you mentioned that the market favorite has been Infosys and TCS, but, people don't realize, I would just urge everyone to see the relative price performance of all the large tech companies, and they will realize which company has done the best. But anyway, coming to your question on the digital theme, one is, frankly, I do believe that we are a very liberalized country, and as a result of which we have not been able to participate by investing in something like, say, Facebook, or WhatsApp, even Amazon. And some of these companies have benefited a lot because of the huge, consumer base they have in India, because they can have 100% subsidiary here. Whereas in China, you had homegrown companies like Alibaba and Tencent and WeChats of the world. And therefore, the opportunity available for public market investors is very limited. This digital theme is going to last for a long time. In fact, it has got a big boost in the COVID times because I've said this earlier, the way we work, the way we study, the way we consume, the way we shop, the way we entertain ourselves has completely changed. And this is here for a long time. I don't remember now that whether you need cash in your day-to-day, anything you do, you can just walk without a wallet if you have your phone here on hand, and you will not be inconvenienced. And similar is the case for a lot of these companies. There is this concept of SaaS we already know, but now there's also this concept of CPaaS, the consumer platform as a service. And that is going to be a big thing. I think the biggest bet we have is a CPaaS company. And, for example, every purchase you do on Amazon results in 7 to 8 messages. You go to an ATM, you need an OTP. You do any shopping, you need an OTP, two-factor authentication, and so on and so forth. So I think the growth potential are immense. The only thing which we have to look at when you invest in something which is a digital or a high-end company is the ability of the management to keep on evolving, to keep on adding new services, being up to date as far as technology is concerned. You don't want to be stuck in a company which is good right now, but which can become obsolete in 2-3 years. So I think that is the only one thing which I would advise the investors, that to invest in companies which have the ability to keep pace with the huge change in technology which has happened. But huge potential, and you just have to see what has happened in countries like US and China, and suddenly you will realize the huge opportunity which lies ahead of us.
What is in store for the classics this year? HDFC Bank, Asian Paints. We've made a case every time that these are expensive stocks and do not justify a classic framework of valuation. But whether it's liquidity or whether the ability to grow, Asian Paints, HDFC Bank, Bajaj Finance, they are still at an all-time high. What is in store for the classics this year?
So, without going into specifics, I would say that the bank you referred to is a great institution. They keep on growing at 20%. And it's not very expensive on a PE basis. So I'll keep that apart. But, markets are a function of a lot of things. They are not only a function of valuations in the near term. There is a huge flow of capital which has come from overseas in the last 2-3 months. And a lot of that flow is, I would say, passive money. I also call it dumb money because it is not based on a view on the stocks. It is based on the view as far as the emerging market piece is concerned or India as a country is concerned. And when such huge flows of money comes in, all these sort of heavyweights in the index get an automatic allocation. And because obviously these companies are large companies, they don't need capital. So it leads to a buying from the secondary market and therefore the price action. I am not in the camp of buying companies which don't justify the price you pay today being justified by the future cash flow expectations. And therefore, if the company is growing at 25-30%, maybe I'll give it a 40-50 PE because it will justify it by way of the future cash flow which we'll receive. But a company growing at 10-12%, trading at 70-80 PE is something which I don't understand. And there are investors who understand that better, and they have done decently well. So I think from an investment perspective, everyone would have a different way of investing. Everyone will have a different perspective, and that is how markets are made. But our view is that we understand what we do, and we will stick to that.
Okay, Sunil, two more very quick follow-up questions. The positioning of your fund is that you are investing in semi-mid cap and semi-large cap stocks. That's the differentiation factor. But when you're investing in some of these companies, the assumption is that they will see an earnings growth and an P expansion. But when markets, wherever they will reverse because of risk or because of liquidity reversal, some of these stocks also have a issue, which is that they will fall much more than the market. So how are you looking at minimizing that risk? Because your optimistic view is perhaps indication, endorsement of the stocks you own. But how would you mitigate if markets go haywire?
So, you are right that when the markets correct, the broader markets tend to correct more. But that is fine. There is a difference between risk and volatility. I would not say that these are higher risks. I would say these are higher volatility. And if your perspective of investing is 3-4 years, then volatility gets evened out. So, we always reach out to investors and seek investments only from those who have this 3 to 5 years perspective. We are not here to make money from a 3-6 month basis. The other thing is, it's all about earnings, So, there was a movie which said that it's all about entertainment. I think equity markets are all about earnings. So I think what we tend to do is try and build a portfolio where profit can double in 4 to 5 years' time. And our view is that if you have that kind of a portfolio, you can not go wrong. The P multiples vary from time to time. We had a Nifty P multiple of 10-12 times in the bottom of March. We are now at 20-25 times 1 year forward today. So, how P multiples can change within months. And the last thing is, from the very popular tele-serial, risk hai to isk hai. I think unless you take some risk, returns cannot be made. And I think that is what investors have to realize. If you want a completely risk-free kind of an environment or your portfolio, then you have to be in G-Secs. You can't be in equity markets.
Okay. Last question. I have never seen a market where one side you've got mid-cap stocks which are going higher. On the other side, you've got large cap stocks which are going higher because of FI liquidity. But bang in middle of that, you've got DIs which continue to sell. So FI flows record high, activity by retail investor all-time high, but mutual fund selling also all-time high. Who's getting it right, who's getting it wrong, and how should one read into it?
See, every investor has a different perspective. So when the foreigners sold very heavily in March, April, May, it was the domestic investors who were sort of supporting the market by being net buyers. And maybe, the returns in the very short period of time, anywhere between 50 to 100%, depending on the fund you invested, has made some investors feel that it's time to book profits. Maybe they were expecting 100% return over 5 years and they have got it in 5 months. So they are booking profit. That can be one reason. The second is, a lot of investors came into equity markets in the previous bull run of 16, 17, 18, and particularly on the mid and small caps. And they did not have a great experience. And now when they are coming back to their, maybe the cost price, there is a natural tendency, for investors when they have a bad investments, that whenever they get back to normal break even, they redeem. I think that would be the second thing. Third is there is definitely a lure of investing directly, particularly from the HNI community. And we have seen that quite a few super HNIs have resorted to, moving out of maybe mutual funds and moving into, niche portfolio management companies like ourselves, or even going directly. So it's a combination of a lot of things. Who will turn out right, who will turn out not, I don't know. But investors who are invested from a 3-5 years perspective, all of them would be right. And that has been proven time and again over the last so many years.
To have you on the show as always, and here's wishing you and your entire team at Abakkus a very happy and prosperous 2021.
To you too. Thank you.